Good morning, everybody. Welcome to the Reserve Bank. Welcome to the release of our financial stability report for the latter part of 2010. In this report, we note that the New Zealand financial system has benefited from the recovery in the global economy, and that banks are now better positioned both to meet future credit growth and meet future credit demand and to support economic growth. The domestic economy is seeing domestic rebalancing proceeding, but we do note in this report that some of the pressures on the New Zealand dollar have not been helping that rebalancing. We observe that households and businesses are keeping their own spending low as they attempt to reduce their own debt. And together with the increase in export commodity prices, this is all assisting the current account and external indebtedness to decrease. This overall has been positive for financial stability. But the New Zealand dollar is staying relatively high, and this is reflecting easy monetary conditions internationally and weak economic activity in the major developed countries. If this is sustained, we do see the continued rebalancing of our economy towards the tradable sector becoming increasingly difficult. Emerging Asia is still the main engine of global growth, and that of course is positive for New Zealand. Financial markets have generally become more stable since the European sovereign debt crisis in early this year. But the widespread withdrawal of fiscal stimulus and the debt reduction by households and businesses does continue to pose some risks to the global recovery. In the United States, new quantitative easing measures have been recently announced. This is supporting risk asset markets, but it is also putting pressure on capital inflows and exchange rates in third country economies, and that in itself is problematic for international rebalancing. To take you through the second part of the report, I'd like to hand over to Grant Spencer, Deputy Governor. Thank you, Grant.
Well, with respect to the banks, we think they are in pretty good shape. On the funding side, they've been lengthening their borrowing and increasing more deposits, so that in terms of their stable funding, their actual ratios are in excess of the core funding ratio minimum that we set down in our new policy in April earlier this year. So they're looking pretty comfortable on the funding. And I would note that given the stability of the bank liquidity at present, yesterday we announced that we would be removing the last remaining crisis liquidity facility, and that will be coming off in a couple of weeks. On the asset side of the banks, non-performing loans are plateauing. They're stabilising at around 2%, which isn't that high a level given the recession we've had. And we think that we expect that with the recovery continuing next year, that those non-performing loans will start to come off through 2011. The main risks around bank credit, we think, are probably on house prices and agricultural prices, but we don't see either of those risks as particularly significant at this point. In the non-bank sector, we have seen further failures over the past 6 months, most notably, of course, South Canterbury Finance. But we do think that the remaining firms in that sector have relatively low exposure to property development, and that they're well placed now to consolidate and to provide a basis for a return to growth in that sector. I'd also note the non-banks are coming into compliance with the new prudential regime that we have, our new non-bank regime, which most of that will be in place by December next month, in other words. One important development for us has been the passing on the 7th of September of the Insurance Act. So that now means that the Reserve Bank will be responsible for the prudential supervision of all insurance companies in New Zealand. But this is a regime that will take some time to come into place. We're gearing up for it, and that will be introduced over a 3-year period. Finally, I would just mention Basel III. This is the new initiative from the Basel Committee, which bolsters the capital and liquidity requirements for banks internationally. And we expect that the Basel III proposals actually will be ratified by the G20 meeting in Korea later this week. Those are not strictly necessary for every country to adopt, but we have a generally positive view of the Basel III initiatives, but we'll be looking at them closely in terms of before we actually adopt them within the New Zealand regime.
Good, thank you, Grant. So thanks. We're open for any questions you might have.
Across the road at Parliament, there's been some debate in recent weeks between the politicians on both sides of the House about interventions to bring the currency down. Labor is favouring an intervention, the government's not. What sort of resources are available to the Reserve Bank, and what strategy would you favour?
Well, we've got a well-documented policy which says that we're prepared to do limited intervention under quite unusual circumstances, which is either at the very top or the bottom of the cycle, where an intervention would meet a number of quite stringent tests relating to the unjustifiable nature of an exchange rate given where the economy is, and where in addition we felt that intervention might be practical or opportune in financial markets at any particular time. But we'd make the obvious point that there's no way that New Zealand can stand in a market against something which is being driven by the major economies offshore, and that's always been the case. That policy hasn't changed. Beyond that, we don't comment about when we will intervene.
Is the currency at an unjustified level given the state of the economy?
The currency has been going through an unusual time where until about 2 weeks ago it had actually been through 5 months of stability if you look at the trade weighted index, which is where we tend to look. Of course, individual people are either been benefiting or losing quite significantly from the fact that against the US dollar we've gone very strong, and against the Australian dollar we've gone much weaker. That's been quite an unusual situation where the US and the Australian dollar have moved apart very significantly over that time. Now that's changed a little bit over the last 2 weeks, but that's still very much short-term volatility.
Is the bank contemplating any changes to the conditionality around intervention, and if so, what might those changes be, and would the government need to sign off on them?
No.
On South Canterbury Finance, the former chief executive there, Sandy Mayer, in a letter to the government, warned of quite serious financial stability issues if the company was to go under, which it now has, obviously. What's your view on the impact there now, and are you satisfied that there are sufficient institutions taking up the slack in terms of lending to the rural sector in the South Island?
Well, what we call the non-bank deposit-taking sector has contracted very markedly before and through the crisis. That's also been accompanied by a big fall in demand for finance for the property sector, which is particularly the part that's obviously been most hit. At the minute, we're not hearing of major issues around unfulfilled demand for property sector financing, partly because there isn't much demand at the minute. We expect to see the market replace that gap over time. It may happen in different ways. It may happen more with non-deposit taking financial institutions. We're already hearing of plenty of interest around the place, but that's yet to see how that pans out. That sector has contracted very significantly.
Rural sector there?
Well, we're not hearing about problems of farmers being unable to access funding. There's been a very big increase in agricultural sector lending over the time. At the minute, most farmers are trying to reduce debt, not increase debt.
What's your primary concern around intervening in the markets to bring the New Zealand dollar down? You've obviously got some concerns about it. Is it about the losses that the bank could sustain if it built up a large stock of foreign currency? Is it about inflation? What are the main concerns?
It's not primarily about the losses that the bank could sustain, but indeed the bank could sustain significant losses if it were to get into a big open FX position. It's broadly a recognition of the fact that what we're seeing on the New Zealand dollar is being driven by a much bigger international move at the minute. So as a broad generalisation, much of the pressure on commodity exporting currencies at the moment is coming from, is related to quantitative easing in the United States. There's no way a small country can lean against that. You're seeing countries with much bigger resources try to do that. Japan, about 6 weeks ago, intervened heavily in the FX markets. They did have an impact on the yen. It lasted about a week, and then it's leached out of the system. Earlier this year, the Swiss National Bank carried out some quite major interventions. They were concerned about the rise in the Swiss franc. Similarly, they had an initial effect. It didn't endure.
Is there an argument, though, that just because of the speed that the dollar has shot up, especially against the US dollar, that the bank should be intervening to give firms some time to adjust, some leeway to adjust?
Well, we don't think that we can have a significant effect against the US dollar where it is driven by, for example, US dollar market weakness. If it's driven by more local factors, then that's a different feature. And we do observe that over the last couple of weeks, the financial markets have taken it into their head to interpret some New Zealand data more strongly than we might otherwise do. We'd also note that, of course, if the New Zealand dollar stays at relatively high levels, that does reduce pressure on monetary policy, and the markets will presumably reach the conclusion that there would be likely less of an increased track in interest rates in New Zealand, which in itself ought to moderate their interest in the exchange rate.
Just a follow-up to that question, what New Zealand data has been interpreted more strongly than you would?
Well, we've seen over the last couple of weeks unemployment data, retail trade data, which are broadly what we were expecting, broadly what the market was expecting. We've actually seen some slightly more negative data in other countries that have had a rebound effect here, like Australian CPI data. We're not seeing any fundamental change in our understanding of the New Zealand economy out of that data. Some of the market seem to think there was.
Following the US quantitative easing, do you see a heightened risk of competitive devaluations intensifying the pressures that you already worry about on the New Zealand dollar?
Yes, we think there's an international risk there. That risk has been around for the last few months. The international, well, the large players are clearly aware of it. They're meeting tomorrow in the G20 leaders meeting in Korea, and I'm sure that will be discussed. There is a risk. We've seen the headlines around US and China currency tensions, but from our point of view, we wouldn't want to see a number of other emerging market economies revert to a more controlled structure. We don't think that would be helpful for the world.
Some other countries are imposing capital controls and taxes on bond investments. Should New Zealand look at something like that?
We note that the countries that are doing that are, first of all, ones that have got limited and not completely open exposure to international markets. Secondly, they are notably doing it at the margin rather than getting in a major way, as happened after the East Asia crisis. So we haven't seen a lot of that happening, and we don't think it's in general applicable to New Zealand policy options.
I know there's some mention there of potential risks, particularly within the rural and farming sector around mortgages, particularly for those with the higher debt to income ratios. How immediate a problem is that perceived by the bank?
Well, we don't think it's an immediate issue because the agricultural prices, in particular dairy prices, are really quite high at present. But we've seen, as occurred last year, that these prices can be quite volatile, so they can move to high levels and then drop, you know, with the international cycle. So we're aware that some parts of the farming sector and the dairy sector are pretty highly geared and would be vulnerable to sharp movements in those prices, downward movements.
Dairy, which other specific sectors within the farming sector would be at risk?
Well, that's a sort of dominant sector that, from a financial stability point of view, that's a thing that would impact the banking system. But obviously there are other sectors that are vulnerable in the agricultural sector, for example, the wine sector at present. But that's not going to have such a big impact on the financial system.
The President of the World Bank has suggested that the global currency system should be realigned and include some perhaps basket of currencies as some sort of reserve, and mentioned the gold price as one way to collect that together. Do you think a return to some sort of gold standard is possible or should be considered?
Bernard, I suggest you read some of the books about the 1920s when the world was on the gold standard and see what a very difficult time that was when you've got an artificial unit of account that can't adjust to price movements, and where you see how some countries manage to manipulate that in a way that looks rather like the currency tensions we're having today. That's a no.
And because some central banks are buying gold, has there ever been a consideration by the Reserve Bank of New Zealand to do that?
Not in the last 30 years, as far as I know.
Could you give us an idea on how the banks are progressing towards the 75% core funding ratio, and whether you're still on track to achieve that for, I think, April next year?
The intent there, it's currently the minimum ratio is 65. The intention is midway through next year to go to 70, and then the following year to 75. Right now, as I said earlier, the banks are comfortably above 65. In fact, they're in the region of sort of 70 to 75. So the banks are already at the sort of levels that we're targeting to achieve over the next couple of years. So in that sense, we certainly intend to increase the minimum level as planned, unless unforeseen circumstances change the shape of the game.
And the issue of capital levels for rural lending, there was a delay until the end of this year. What's the status on that?
We are in discussions with the banks at present. They are modifying their risk models in the rural area, and they need to check those with us to make sure we're happy that the parameters of those models make sense. The net result is that overall risk weights on agricultural lending will increase somewhat compared to what they've been, say, earlier this year. But the banks are recognising that and already changing the models to increase the risk weights. They're recognising that there is significant risk in agricultural lending, and that needs to be better reflected in their models. And we're working towards it, and we should, later this year or early next year, reach agreement on you know, where those risk weights sit.
Banks apparently have said that this would increase their costs and that would be passed on to farmers. Is there any estimate of how much that cost might be, and whether it should or will be passed on?
But when the risk was underweighted, then the huge lending that occurred to the dairy sector in particular back in '08 was really done on the basis of an underestimation of risk, and the pricing was too thin. So now the banks have already adjusted their pricing on agricultural lending back to more realistic margins that reflect the risk in that business. So I don't think that pricing is going to change going forward from where it has been over the past year or so.
Give an update on what the bank's thinking is on macroprudential policy as a means of regulating the economy, not using the cash rate, and how that might help, whether or not you see it as a tool to take some pressure off the currency.
We're pretty cautious about that. We lay out our views in this report, we've put them on the table. We generally see room for some macro financial policy to act as an automatic stabiliser, but its scope as a discretionary tool is much less obvious in this. So it's not a silver bullet. So, can't hear.
I mean, are there any ways that you can bring the currency down other than just jawboning it as you've done today?
Well, as I've said, that depends on what's holding the currency up. You need to bear in mind that New Zealand is getting extremely good export commodity prices. These are primarily going into the primary sector. Some of them are being banked. It's not necessarily resulting in money flowing through the high streets. But we are getting very good returns, and that should result in stronger export prices. People are complaining about export prices are sometimes in different sectors where they're not, but that's the reality. We've only got one currency for New Zealand. If, in addition, that's being bid up by these large international developments, then it's very limited what New Zealand can do. And New Zealand now, as always, has got to do the best it can in a difficult world in a realistic sort of way. If there's some misinterpretation of New Zealand data, as we feel there might have been over the last couple of weeks, then we'd look for the market to correct that, and we'll be talking further about that when we put out the monetary policy statement in a month's time. Any more questions, ladies and gentlemen?
Are you concerned in the long term that central banks elsewhere doing bigger by neighbour sort of competitive devaluations will mean that New Zealand doesn't rebalance its economy? And is there anything you can do about that?
Well, Bernard, you will know the old Swahili quote about when elephants make love and make war, the grass gets crushed. And that is a risk for smaller economies in a situation like that. Perhaps luckily there's more discussion at the G20 level now, which does include a number of countries that have got our sort of interests at heart, other commodity exporters, emerging markets and so on. Yes, there's risk for the world in that, but it's not in the interest of the major economies either to do unilateral things which lead to other more broad problems, and I think that's come home to them pretty clearly over the last few months.
Just following on that, what would you like to see come out of the G20? What would constitute a good outcome from your point of view?
We'd like to see an understanding on both sides of the Pacific and indeed the Atlantic that it's very important that exchange rates reflect sustainable long-term real economic competitiveness and real economic prices to give the right sort of signal, and that they're able to give enough confidence to the markets that that sort of position can be reached in a reasonable time.
Just finally, there's been a lot of debate across the Tasman about Australian bank profits and whether they're colluding on pricing. Are you concerned about the level of profits or how the banks, those same banks here, are operating?
No, I think the situation here is quite different because credit demand has been so weak in New Zealand over this period, and that's in contrast to what's been happening in Australia. So bank balance sheets are very static at the moment, and I think you'll see that reflected through in returns generally. Well, thank you, ladies and gentlemen. If there's no more questions, thank you. That's the end of this press conference.